and welcome to Mint. I'm Nasrin Sultana. As Indian economy is facing major macro headwinds, I'm joined by Mr. Madan Sabnavis. He is the Chief Economist at Care Ratings. So Madan, welcome to the show. So as we are headed towards the policy on 7th, what's your expectations? There isn't widely expected that the RBI is going to cut rates, but what do you think about the stance?
See, actually, if you look at the RBI policy, personally, I feel that at this particular point of time, cutting interest rates is not really going to work because we have a problem on the demand side, which we have spoken of, that consumption is down, investment is down. So even if I'm going to give you cheap funds, the question is that is industry going to invest or not? So if you look at the average capacity utilization rate in India, it's around 74-75%, not very well spread across different industries. And typically in India, we need capacity utilization rates of 78 to 80% before fresh investment comes in. So most industries today are not investing because I don't have demand. Right. So can you really expect the automobile sector, which we are talking of, should they be going in for expansion? The answer is no. You're laying off staff, your sales have been falling, so therefore your production is getting affected. There's no reason even if I get funds at 6%, I'm not going to really invest. So I think that's the fundamental issue which we have here. We have a demand side problem which we're trying to tackle through the supply side, through the monetary policy, which works probably at a margin. Because if I'm talking of something like home loans to grow, yes, people like you and I, we would probably buy a house in case we want to. But the question again is that is my income comparable enough for me to actually pay my EMIs? So therefore, even we are seeing in terms of housing, why definitely at a margin people do find it cheaper to borrow funds when interest rates come down, we haven't seen that kind of an upsurge in terms of demand for housing. So that is one part of it where I feel that even if you lower the rates, it may not really work. And maybe a week back, if I spoke to you, I would have said that the RBI would maintain a status quo position. But if you see some of the developments which have taken place in the last 1 week has made us change our stance to saying that there will be a rate cut. The reason being that the core sector data has been very, very disappointing. Right. And at 0.2% gives a feeling that it's not a development, things are really stagnating, maybe we're moving downhill. So therefore growth is going to be a major concern. Second, there was always this case of saying that the monsoon didn't start off too well. And there was a feeling that with a 19% deficit, which we had maybe 10 days back, that there could be certain kind of disruptions in terms of specific commodities, which could lead to higher food inflation. And therefore, it would have made sense for the MPC to say that let's wait for 2 more months before we take a call on interest rates. But I think the latest data from the IMD shows that the monsoon has normalized, which could really give the RBI and the MPC comfort that growth is slowed down. There's no immediate threat of inflation going up, and therefore they could go in for a rate cut of 25 basis points. So that's what our call is, that there will be a 25 basis cut in interest rates. It would probably send the right kind of signal to the market to say that the RBI is doing everything that can be done in order to make sure that growth takes place. The stance will probably continue to be accommodative. So the RBI governor had earlier mentioned that he has already lowered the rates by 75 basis points. He's changed the stance to accommodative, which tantamounts to saying that it's 100 basis points. So maybe today we can say it's going to be 125 basis points. So the important thing is whether this 100 basis points cut over the last few quarters is actually going to lead to higher investment. So I think we keep debating about saying that will the transmission take place, will the MCLRs go up, will the WALR go up or come down rather. So these kind of transmissions could take place, but ultimately I still believe that unless there is demand, people are not going to really go in for higher investment. Right. So from the point of view of policy, yes, there will be a rate cut, but will it lead to an increase in investment? I really don't think it's going to happen this year. Right. We may have to wait for another year.
Another year.
Another year. I think 2021 is when we can really expect investment to pick up. Because if I also look at infrastructure, we have the NPA problem, which seems to have come under control. But at 9.5% NPA level, I don't think banks are going to be too eager to lend to the private sector, especially for infrastructure. Right. So most of it is going to be for maintenance investment, for working capital purposes. And we have seen the bond market is virtually closed for companies which don't have a very good rating. So even though we have enhancements being spoken of both by the RBI and the government, we're trying to move people from bank loan to the bond market. But ultimately in the current situation, I need the credit rating of companies to improve. And the environment doesn't look too congenial right now.
Thank you, Mr. Sabnavis. That was interesting. So, Care Ratings expect that there could be a cut in the interest rates. However, it is very important to see how much will that actually materialize in increasing the demand. We'll have to see how the macro pans out by FY20. Thanks for watching. For more details and updates, stay tuned.